Here's a summary of DHI's Q3 2025 earnings call transcript, designed for clear and concise delivery. Start summary. Good morning. D.R. Horton, America's builder, has reported strong results for the third quarter of fiscal year 2025, exceeding expectations. Key financial metrics: earnings per diluted share, $3.36 consolidated pre-tax income, $1.4 billion consolidated revenues, $9.2 billion pre-tax profit margin, 14.7% home sales gross margin, 21.8%, which was flat sequentially and above guidance. Homes closed, 23,160 net sales orders, flat compared to the prior year quarter, but up 3% sequentially. Cancellation rate, 17%, which is at the lower end of the historical range. Average closing price, $369,600, down 1% sequentially and 3% year over year. Average number of active selling communities, up 4% sequentially and 12% year over year. Home building SG&A as a percentage of revenues, 7.8%, up 70 basis points year over year, reflecting increased community count. Cash from operations, trailing 12 months $2.9 billion shareholder returns, trailing 12 months $4.6 billion returned through repurchases and dividends. Home building pre-tax return on inventory, 22.1% consolidated return on equity, 16.1% consolidated return on assets, 11.1% management's forecasts for future quarters. Fourth quarter 2025 revenue, expected to be between $9.1 billion and $9.6 billion. Fourth quarter 2025 homes closed, projected to be between 23,500 and 24,000 homes. Fourth quarter 2025 home sales gross margin, expected to be between 21% and 21.5%, reflecting an anticipated increase in incentives. Fourth quarter 2025 consolidated pre-tax profit margin, projected to be between 13.6% and 14.1%. Full year fiscal 2025 revenue, now expected to be approximately $33.7 billion to $34.2 billion. Full year fiscal 2025 homes closed, projected to be between 85,000 and 85,500 homes. Full year fiscal 2025 stock repurchases, planned to be between $4.2 billion and $4.4 billion. Significant risk factors, affordability constraints, and consumer sentiment. These continue to impact new home demand. Elevated sales incentives. Management expects incentives to remain elevated and potentially increase further in the fourth quarter, impacting gross margins. Mortgage interest rate volatility. Changes in interest rates are a key factor influencing demand and incentives. Economic environment. General volatility and uncertainty in the current economic landscape. Highlights: solid profitability. Achieved a strong pre-tax profit margin of 14.7% and a home sales gross margin of 21.8%. Capital efficiency. Generated significant operating cash flows and returned substantial capital to shareholders. The company's return on assets ranks in the top 15% of S&P 500 companies over multiple periods, demonstrating a disciplined, returns-focused model. Improved construction cycle times. Cycle times improved by approximately 2 weeks year over year, allowing for faster inventory turnover. Strong lot position. Maintained a robust lot position of 600,000 lots, with a focus on controlled land. Rental operations performance. Generated $55 million in pre-tax income from rental operations. Financial services strength. DHI Mortgage financed 81% of homebuyers, with solid FICO scores and LTV ratios. Shareholder returns. Significant share repurchases and dividend payments underscore a commitment to shareholder value. Reduced completed spec inventory. Progress made in reducing completed inventory, which is expected to continue. Product affordability focus. Efforts to provide smaller homes and utilize smaller lot sizes to enhance affordability. Lowlights. Increased SG&A. Home building SG&A expenses as a percentage of revenues increased year over year due to higher community counts. Sequentially lower gross margin expected. The company anticipates a lower home sales gross margin in the fourth quarter compared to the third quarter due to increased incentives. Geographic outlier. Sales were noted as slightly lagging in the Pacific Northwest, attributed to the tech buyer market and job market uncertainty. Most important statements from management. CEO Paul Romanowski. The D.R. Horton team exceeded our expectations and delivered solid results for the third quarter. He highlighted the company's disciplined approach to balancing pace versus price, maximizing returns in each community. Romanowski emphasized the company's focus on capital efficiency, generating substantial operating cash flows, and delivering compelling returns to shareholders, noting strong rankings in return on equity and assets. He acknowledged ongoing affordability constraints and cautious consumer sentiment, stating that sales incentives have increased and are expected to remain elevated. We are well positioned, offering our customers an attractive value proposition with quality homes at affordable price points, and we have a positive outlook for the housing market over the medium to long term. He concluded by expressing confidence in a solid finish to our fiscal year and a positive medium to long-term outlook for the housing market. CFO Bill Wheat, regarding Q3 gross margin beat. Our incentives were a bit choppy during the quarter. It was a little more balanced, and it didn't impact the closings and the margins quite as quickly in the quarter as we anticipated. On Q4 gross margin guidance, we still, as we sit here today, see a trend of higher incentives. Our recent sales and our current sales and backlog do reflect a higher cost of incentives. So the closings that we see into July, August, September, we do expect margins to take that step down that we had previously anticipated would occur in Q3. On increased share repurchase authorization. It's always a balance between what we see in terms of our cash flow, our liquidity level, our leverage on our balance sheet, and we're in our target range there. And so we've had the room to be able to devote a bit more capital to the share repurchase this year. On inventory efficiency and ROE. We are very focused on inventory efficiency and improving inventory efficiency throughout all aspects of our operations. We are very focused on continuing to improve those turns. And so with that, we do expect to improve the efficiency of our inventory levels. And so that will be a key component to stabilizing and then improving our returns on assets, as well as then our returns on equity, and our consistency of cash flow generation. Regarding rental segment margins, we do expect, while revenues may still be, in the same ballpark or better than where it was this quarter, we do expect margins on the sales in Q4 to be lower in the rental segment than they were in Q3. End of summary.